This Week in Economics on the 18th of February 2018 from WBRN Radio in Boston and on the Bostonred Network. This is our macroeconomics program and numbers man here, as we have labeled this particular production for the last number of years. Nonetheless, the economy, very interesting situation out there. The new tables, incidentally, for deductions from the IRS are now making their way to employers. They were released on the 15th of February. So some people will not see the results until early March, depending obviously on their pay periods. But we have seen some information from the press that people, depending on what their situation is, basically around $120 a month extra in their paychecks. Now, some people are aware that obviously other income brackets are receiving more. These are people making around $50,000-$60,000 a year that are getting these. They were interviewed outside of Pittsburgh, Pennsylvania. Now, what happens on tax cuts? Immediately, people receive, let's say, for instance, their first paycheck that the $120 a month applies, and then obviously you move from month to month. This is more of a micro situation, not necessarily macro, but it's macro from the sense that what you're doing is, on a national level, you're putting extra money into the economy. However, you also at the same time can cause inflation to go up, and Americans tend to be inflation conscious. A modern industrial capitalist economy such as the U.S. can survive on 2.5-3% inflation. Now the Fed has their target at 2%, and part of the reason the historic trend has been when inflation starts to move, we'll say above 3%, it can immediately go to 5% and so forth and so on. And in the 80s, we were at 17, 18, 19%. And people that were into CDs were just simply rolling them over. So thus, it would depend. Obviously, the structure of the economy has changed. Now you have a lot of, a larger part, I should say, of the economy in equity markets. And equity markets survive on lower interest rates. So that in itself is different, and also depending on business borrowing, acquisitions, etc. Part of it, and you also look to the quote-unquote shadow banking economy. Various companies there, the mutual funds, the annuity funds, etc. are out there. All kinds of what they label financial products. So all of these things revolve around interest rates and mortgage rates. In this program, we'll be talking about the producer price index, housing, consumer confidence, some of the things we'll bring up early here. So let us go to the consumer price index that was released on the 15th, was Thursday of February. Nonetheless, this is for January, increased at 0.4% in January, seasonally adjusted. This is from the Bureau of Labor Statistics. Final demand prices are unchanged here in December, moved up to 0.4% in November. On the unadjusted basis, the final demand index rose to 2.7 for the 12 months ending in January. In January, the rising index for final demand is attributable to a 0.3% increase in prices for the first demand services and a 0.7% advance in the index of final demand goods. The index for final demand, less food, energy, and trade services rose 0.4 in January, the largest advance since the 0.5 increase in April of 2017. For the 12 months ending in January, prices for final demand, less food, energy, and trade moved to 2.5%, the largest rise in 12-month percentage change were available in August of 2014. Final demand services prices for final demand services advanced 0.3 in January, following a 0.1 decline of the month earlier, that being December. Nearly 2/3 of the broad-based increase is attributed to the index for final demand services, less trade, transportation, warehousing, which moved up 0.4. Transportation warehousing advanced around 0.4%. Products detail a major factor in the January increase in prices for final demand services was the index for hospital outpatient care, which rose 1%. The index for apparel, footwear, and accessories, retailing, health, beauty, and optical goods, retailing, residential, real estate, services, long-distance motor carrying, and hospital inpatient care also moved higher. And in contrast, margins for chemicals and allied products wholesale declined 2.3%. Prices for wireless telecommunications services and airline passenger services also fell. Final demand goods, the index for final demand goods jumped 0.7 in January, the sixth consecutive increase. Over 80% of the January advance can be traced to prices for final demand energy, which climbed 3.4%. The index for final demand goods, less food and energy, was at 0.2. Conversely, prices for final demand food fell 0.2%. So we kind of an interesting situation here. If we look at January 2017, the total final demand there was 0.5%. This is 1 year ago. Food at 0.2%, energy at 3.8%, for a total of 0.4%. Trade at 0.9% here. So we go forward to January of this year. 0.4% was the total. The 1/10 difference there. 0.4 on food, energy, and trade. A total of 0.7 there. So we do have a little different situation aspiring here. Within the immediate demand in January, prices for processed goods increased 0.7%. The index for unprocessed goods advanced 0.7, and prices for services edged up 0.1%. Processed goods for intermediate demand, the index for processed goods for intermediate demand climbed 0.7 in January. The sixth straight rise there, 0.7 of the January advance is attributable to a 2.5% increase in the price for processed energy goods. The index for processed materials, less food and energy, also moved higher to 0.3%. Conversely, prices for processed food and feed moved 0.3%, and over the 12 months ending in January the index for processed goods for intermediate demand services at 4.6%. Product demand, a major factor in the January increase in prices for processed goods for intermediate demand, was the index for diesel fuel, which rose 5.1%, price for gasoline, commercial electricity, power, jet fuel, primary non-ferroneous material and copper and brass milled sharps also moved higher, and in contrast, processed eggs index fell at 13.2%. Prices for utility natural gas and ethanol also declined. On processed goods for intermediate demand, the index for processed goods increased 0.9 in January, the third straight advance. Most of January's rise can be attributed to the index for unprocessed non-food materials less energy, which climbed 3.8%. The index for unprocessed energy materials advanced 0.5%. Conversely, let's see, prices for unprocessed foodstuffs and feedstuffs declined 0.8% for 12 months ending in January. The index for unprocessed goods for intermediate demand climbed 2.5%. So we can see that prices here are moving in the, let's get the last one, in the index for unprocessed goods. Demand was prices for iron, steel, scrap, which jumped 12.9%. The index for crude petroleum, slaughter, boars, and gilts, slaughtered chickens, corn, and non-ferrous scrap also moved higher. In contrast, the price for slaughtered cattle fell 4.9%. The index for natural gas and waste paper also moved lower. Some of these commodity prices very interesting here. Services for intermediate demand, price service for intermediate demand inched up 0.1%. They are leading the increase. The index for services less trade, transportation, warehousing advanced 0.1%. Conversely, margins for trade services for intermediate demand decreased 0.3% for 12 months. Product details, a 2.7% increase in index for business loans. The first time we've talked about loans here was a leading factor in January's rise in prices for services for intermediate demand. The index for security brokerage, dealing with investment advice and related services, network compensation for broadcast and cable TV, paper, and plastic products, wholesaling, and long-distance motor carriers also moved higher. In contrast, margins for chemicals, allied product wholesaling fell 2.3%. The index for machinery and equipment parts and supply wholesaling, internet advertising sold by non-print publishers, and airline passenger services also decreased. So this is very important here in the sense that internet services were down, or internet advertising was down, sold by in other words, this would be non-print publishers, the Googles of the world, etc. Stage 4 intermediate demand, price stage 4 intermediate demand advanced a 0.3 in January after no change in December. In January, the index for total good input to stage 4 intermediate demand climbed 0.7. Increase in diesel fuel, gasoline, commercial electrical power, business loans, legal services, paper and plastic products wholesaling outweighed declines in the index for machinery and equipment parts, supplies wholesaling, chemicals, allied product wholesaling, and prepared poultry. I suppose Colonel Sanders there. For 12 months ending in January, prices for stage 4 intermediate demand were up 3.1%. Stage 3 prices rose 0.4% there in January. Prices for total goods input to stage 3 intermediate increase at 0.8. The index for total services input was unchanged. Higher prices for gasoline, jet fuel, slaughtered boars and gilts, slaughtered chickens, and business loans, and all thrown in here, outweighed a decrease in the index for raw milk, slaughtered cows, chemicals, allied product wholesaling. For 12 months ending in January, prices for stage 3 intermediate demand also climbed 0.1. Stage 4 in January, prices for goods input to stage 2, intermediate demand moved to 0.5 there. Higher prices for crude oil, network compensation from broadcast and cable TV, legal sales of insurance, liquefied petroleum gas outweighed declines in the index for natural gas. For natural gas, for thermoplastic resins and plastic materials, cable advertising time sales. For 12 months, the price for stage 2 intermediate demand rose 3%. Stage 1, the index for stage 1 jumped at 1.7%, in contrast to prices for service input falling 0.2%. And this would be rising prices for iron and steel scrap, diesel fuel, business loans, partially gas, non-ferrous scrap, organic chemicals, natural gas. For 12 months ending in January, the price for stage 1 intermediate demand moved up 5.6%. Now, this was intermediate demand by product of flows here. They divided into stages. Now, effective with the release of data for January, the producer price index PPI includes data from 31 resampled industries classifications according to the North American Industrial Classification System. The Bureau of Labor Statistics periodically updates a sample of producers providing data from the PPI there. So in other words, the January 2018, we see current issue of PPI details. In other words, it's being much more detailed here, and they have the number classification. Won't go into that, but recalculation of seasonally adjusted factors also play in here. Effective with this release, seasonally adjusted factors have been recalculated to reflect price movement patterns during 2017 from the final demand, intermediate demand, etc. and they list out the months here. We'll append this so you can look at it. PPI weights updates, release price index dated February 15th. The Bureau of Labor Statistics updated the value weights there, and this is always weighting, a statistical method here. We're reflected this weight update, including the industry net outputs indexes as well as indexes for traditional commodity groupings, in addition to weights updates from 2007 to 2012 census. So a lot of things are involved here, and we'll just put this there. So effectively what we are seeing here is increase in the cost of all products. Let's move to consumers, since consumers is a very large part. This is from the University of Michigan. And this is preliminary results for February of 2018. The index of sentiment is at 99.9. The current economic conditions at 115.1. The index of consumer expectation at 90.2. This is February. Now we look at January. The index of sentiment was at 95.7. The current economic conditions at 110.5. You can see it went up a little bit there. And the consumer expectation at 86.3. This was in January of 2018. In February of 2017, the sentiment, it was at 96.3, and at current economic conditions at 111.5. The consumer expectation was at 86.5. That was in February. So we look at the changes here. The index for consumer sentiment at 4.4%. The current economic condition at a plus 4.2%, and then 4.5. From Dr. Curtin, he's the chief economist there. Consumer sentiment rose in early February to the second highest level since 2004, despite lower and much more volatile stock prices. Even among households in the top third income distribution, the sentiment rose to 112.8, the highest level since the prior peak of 114.2 was repeatedly recorded in 2007, 2004, and 2000. Market gyrations were dominated by rising incomes, employment growth, and by net favorable perception of the tax reform. Indeed, when asked to identify any recent economic news they've heard, negative references to stock prices were simultaneously cited by just 6% of all consumers. In contrast, favorable reference to government policies was cited by 35% in February, unchanged from January's highest level recorded for more than a half century. The largest proportion of households reported an improved financial situation since 2000 and expected larger income gains during the year ahead. To be sure, the higher interest rates during the year ahead were expected by a higher proportion of consumers since 2005. Consumers also anticipate slightly higher inflation rates, although the year ahead inflation rate has remained relatively low and unchanged for the past 3 months. Purchase plans have been transformed from attractions have been transformed from the attractions of deep discounted prices, interest rates that outweighed economic uncertainty, to being based on a sense of greater income and job security, as fewer consumers in decades mentioned the impact of lower prices and interest rates. Overall, data signals an expected gain of 2.9% in real personal consumption expenditure in 2018. Now, this is very interesting here. And on the political side, how it will bode for the election. We do that on Bostonred. But how consumers look at the tax cut will be a very interesting situation, and when they vote in November, how those conditions will be. There are positive signs here, and there are also negative signs here. For instance, if we look at record highs in 2007 for people that were around or paying attention. 2007, we were coming into an election year in 2008 and into the Depression. And also we had recessionary activity in 2000 and some in 2004. So we look at this with a quote-unquote sense of scrutiny. Let's just put it at that. The markets have been up and down. We'll get into that now. The various indexes out here, the volatility index has settled down. It was up over 50. That is not the case now. So that has changed. But at the same time, we see inflation coming here, and this is from Reuters, incidentally, so we can make certain where we are here. This dispatch was on the 16th of February. The U.S. stock market are unlikely to return to its unusual calm conditions seen the last year. Here, it's their theme, and we'll get into some of these indexes here. The market volatility spiked to multi-year highs. The volatility index, known as the VEX, the most widely followed barometer there. The stocks last year logged a historic low of 11%. The VIX reached a 2.5-year high of 50.30. That was on February the 6th. Since then, it slipped back. It's now at 17.60, still well above the low record hit of 8.56. That was in November. Fears have come down drastically, but certainly not to the level of complacency seen per correction, as is from Randy Frederick, Vice President of Trading and Derivatives at Charles Schwab in Austin, Texas. The VIX future seems to indicate that the VIX could trend down from current levels to maybe as low as 15 over the next couple of months, but there are few, if any, signs we'll see 10 again. The VIX is derived from the price of S&P 500 options and is an indicator of investors' collective estimate of near-term gyrations from benchmark stock indexes. The S&P at 2004-7, a VIX of 15 implies a daily movement of the index of 21.54 points, or close to 0.8%, Frederick said. There have been 8 days this month when the S&P logged a single day move of more than 1%, compared with 8 days of all of 2017. You're probably going to be bopping up and bopping down. It's sort of like our seesaw model, but a little different on stuff that happens. That's Phil Orlando. He's a chief equity strategist at Federated Investors in New York. Some high-profile investors here known on Wall Street as bond kings and hedge fund kings. Douglas Koss from Seabreeze Partners see more stress ahead for stocks. That's also with Jeffrey Gulick. To be sure, higher flows to volatility would not necessarily mean an end to the bull market in equity. 3 years when the VAX logged its highest levels. That was 1999, 203, and 209 coincided with a 20% or bigger gain in the S&P. Well, we'll see. The ProShares short VIC short-term future, which gained as long as volatility decrease or stays low, has drawn about 418 million on net basis since February 6th, the day of the peak for the VAX. Things may be a little different this time. This is the Fed is striking its course balance sheet. If you remember, quantitative easing. Many conservatives had been advocating the last 2 years or 3 years under the administration of Barack Obama for the Fed to ease their balance sheet, in other words, to lower it drastically. Now we don't hear much about that song and dance, but nonetheless, that will start to happen. U.S. corporate earnings could be the other factor to watch. Well, we've seen a lot of corporate earnings. Very interesting here when you have year-over-year corporate earnings jumping, say, 20% or 25%. In many things, like with Apple, that's unrealistic. It's not sustainable. So we need to do further research on that. Analysts expect the S&P 500 earnings to keep rising for the next few profit periods, peaking at 21. Now, this is the index itself, the S&P, at 21.3 and moving to 17.8. When earnings growth will start to roll over and go from a positive growth to negative growth, a deceleration, you see the volatility increase in the marketplace. That is from senior equity product strategist at Invesco Profit Sharing in Chicago, Nick Livis. I've been counseling clients to think about using products like low volatility or quality to help essentially migrate some of the downside or risks that are present. And there are risks obviously present there. It's not the purpose of this program to give advice, but this is just that will place more emphasis on the quality of active management and stock pricing, asset allocation, all the stuff that theoretically we get paid for. That's from Mr. Orlando. Well, be interesting to see how this goes. And this is one of the things to always remember about, particularly the stock market. It's a over time basis situation. It's not as cryptocurrency. Incidentally, cryptocurrencies have made it back on some of their markets to the $10,000 range. So we'll follow that closely there and see where we are going. GE, incidentally, is exploring industrial gas engine business sale. In other words, they've been selling off parts of their business. This is GE for a very, very long time. Let's just take a look at this before we go to the BBC. There's also, well, we'll get to that in a minute here. General Electric exploring the sale of its industrial gas engine business. Again, they've been selling a number of things off, divesting in industrial gas engines. Which includes a number of engines here, would help streamline GE's power division. Their profits plunged there 45%. You understand why they're doing this. GE has hired Citigroup to prepare a sale process. The unit for sale makes multi-ton gas turbine engines that generate on-site power to keep industrial plants running. The company's stock has fallen half of its value the last 12 months. Fenruary is under pressure, obviously, from investors to correct this problem. Disclosed it's investigating its first some of its accounting practices, a little tricking of the books. So we'll see some of that. There's one other story I wanted to get here, and this is Senator Fluke, of all people, had one of these cars out in California. A little different situation there, but this electrical car, I believe we want. Well, no, this is different here, but anyway, this is the Tesla story, but effectively, she had a different car, but some of the buyers for Tesla, long delays, this is Model 3 sedan, are concerned they will miss out on the big federal tax breaks, are looking for alternatives, including GM's Chevrolet Bolt. So some are looking at Bolt. This is again in California, the top market for electrical vehicles. A Bolt is a driving part of the frustrated buyers away, who are afraid they will lose $7,500 electrical vehicle credit if they wait. The tax credit drops in value and evidently disappears once Tesla sells 200,000 electrical vehicles in the U.S. The Model 3 production has been troubled, and Tesla said that the net number of refundable $1,000 reserved was stable last year. But some of these people are going to literally have to wait till 2019. We're getting Tesla people who wanted their Model 3s. They asked us whatever cars you're interested in. Mostly say Tesla, but they want the car now. So the Chevy Bolt is there. Period. The Tesla, of course, struggling with the Model 3. GM has sold 23,000 Bolts in 2017, a drop in the bucket. The Kelley Blue Book, still around, reported that Bolts are in relatively short supply as a measure by day of inventory, which fell to 42 in January from a high of 65 in August. By comparison, Nissan Leaf, an electrical car with shorter range, was inventoried at 202. So it's kind of interesting here where the Bolt is going. Tesla is closing in on 200,000 electrical vehicle sales thanks to the popularity of its luxury Model S sedan and Model X SUV. So Tesla is still pushing cars out there. My objective is always a $35,000 Tesla for a price decently option. Anyway, this so GM is trying to get into the ball game, and it'd be interesting to see how the market pans out. Let's go now to the BBC. And we'll do the numbers here. We're lucky. The UK, we have some information here on the UK economy also, and we'll get to that from the Bureau of National Statistics. We'll say in a minute here. Headline the BBC is here: U.S. rejects a Chinese firm attempt to do business, and this has kind of been an ongoing situation on the exchange, shutting the Chinese out of the markets. This is a bid. Let's see, for Chicago Stock Exchange. Okay. This would have been a merger between the Chicago Stock Exchange and a Chinese-linked investor group. A decision came with more than 2 years of review. Committee on Foreign Investment in the U.S. pending a further approval from the Securities and Exchange Commission. On the proposal, the Chinese-led North American Casin Holding Group would have bought CHX Holding, which owns the exchange which handles 5/10 of U.S. stock trades. A small exchange, no doubt about it here. Early in the year, the U.S. also blocked a $1.2 billion sale of money transfer firm MoneyGram, that to a Chinese outfit there. So this has been, tit for tat. MoneyGram does a lot of money transfers out of the U.S. And let's see if we can. Now this is in the UK, and we'll have some more here in just a minute on this. Consumers squeeze weights on UK sales. Here, sales show weakness despite growth in gymwear boots. Yeah, and we'll get to from the national statistics. Their office says sports equipment showed strong sales than usual as shoppers set to meet New Year's resolutions. This is in the UK now, incidentally. Sale volume in January were at 1.6, which compared with a year earlier, their inflation has been running at a higher rate. It's the same thing. In other words, there are parallels between the UK economy in this instance and the U.S. economy. Inflation is moving up. More traditional high street stores have been struggling. The same thing in the U.S. Various retailers are closing stores and cutting jobs, and we'll see more and more of this. We'll go into some of these retailers, supermarkets known for the eye on costs, obviously. For the bigger brands there, Tesco, St. Barry's, and Morrison's have announced plans to cut thousands of jobs, stripping middle management there in the UK. Not an unusual situation there. We'll see more and more of that. And the shakeout in the so-called grocery sector, retail grocery sector here in the U.S., we'll see that as competition, or true competition, heats up in some of the markets. We've not seen it as to date because some of the markets actually do not have true competition, but in some other markets we have seen quite a bit of that happening. And let me see if I can locate. Here we go. The retail sales here. In January, the underlying pattern in retail sales is suggested by 3 months on a 3 months measurement, one of the slowest growths, with the quantity increasing by a 1/10, the lowest growth since April of 2017. The monthly growth rate for quality bought increased by 1/10, with declines across many sectors except non-food stores. These are the main points when compared with January 2017. The quantity bought in January of this year increased 1.6 tenths, a slowdown to year-over-year growth when compared with an increase of 2.4% in 2017. The main contributor to year-over-year growth came from non-food stores with sporting goods. We talked about that. And toys increased sales quantity bought by 10.9%. Feedback from a retailer suggests that New Year's resolutions to get fit and lose weight contributed there. And year-over-year growth for quantity bought in food stores showed a decline for the sixth consecutive month at a negative 0.9 tenths, largely due to continual rise in foodstuffs. And we see that in the U.S., rise in some foodstuffs, down in some others. Yeah. And basically, here, basic figures here, the value, quantities bought at 1.6%, excluding automobile fuel at 4.3%. So this is something. We'll attach this table, won't go much into it. Year-over-year growth for quantity bought from retail food stores and non-retail food stores. We have some very interesting things here. Predominantly food stores, for example, supermarkets, specialty markets, predominantly non-food stores. In retail, 40 pence was spent in food stores, 42 pence was spent in non-food stores. We won't go much into that because we'd have to get into pence, and we're not going to do it in this presentation. Nonetheless, the market, the global BBC Global 30, this was on Friday, 33.13, all green here. The FTSE All Share at 33.38. In Amsterdam, they were at 4.70 on a Friday. The DAC at 105.79 on Friday also. In Paris, they were at 59.06. In Brussels, at 33.08. In Madrid, at 117.20. In Zurich, at 68.92. In Moscow on Friday, they were in the negative 10.18. In Johannesburg on Friday, they were also in the negative 294.82. In Bombay on Friday, negative 286.71. In Karachi, 684.75, a good day there. In Lahore on Friday, they were in negative 45.11. In Colombo, 10.48. In Tehran on Wednesday, 244.50. In Sydney on Friday, negative 3.90. The Nikkei at 255.27. And Hang Seng at 599.58. In Shanghai on Wednesday, 14.20. In New York, 19.01. And the NASDAQ was down, negative 16.96. The Merck out in the Midwest city of Chicago, 1.02. In San Pablo on Monday, 1,046.17. And in Mexico on Friday, 648.42. On to commodities. Brent crude was up 61 cents at $64.94. On the spot, it was down 3 cents at $58.59. West Texas Intermediate up 38 cents at $61.55. T-Boone Pickens is still jumping for joy in his retirement. Gold on the Forex was up $4.90 at $1,358.60. And Dubai Gold futures were down $6.60 at $1,350.30. Silver was up 1 cent at $16.83. On to your next life futures. Here, cocoa was down $92. And who else is in here? Feed wheat futures were up $1.25. Robusta coffee was down $90. Interesting here. White sugar was up 2.40. And the Bloomberg Commodity Index was out on Wednesday. Interesting why we always get Wednesday here. Anyway, nonetheless, is at 85.59. Just check something here and see where we are. Okay. Anyway. Thus, those are the numbers as to where we are. Very interesting situation. We'll be looking at in the coming months, the effects of the tax cuts here in the U.S. as people actually see those in their paychecks. They're starting to see those tax cuts and new tables that are out. They were out on the 15th. I'm not certain if some people, some employers got the tax tables beforehand, or some employers were doing an estimation of where they would be. But nonetheless, the March, the old traditional paydays of the first 15th or whatever would be out there. So you'd be in March. A little more certainty around March 15th to the April 1st, people would start to see that money arrive. And the estimates were that most people in the 50 to 60,000 bracket would receive anywhere from $500 to $1,000 extra. And if people are starting to see $120, some are over a month's paychecks. That's about $60 a paycheck, basically speaking, is what people are getting back. Now, we'll look at inflation costs to see exactly where they would end up with inflation running, say, at 3%. We don't have at this time the exact figures. Actually, we don't really know where inflation will be going. I'm just looking at CNBC here very, very quickly to see if there's any take that they have that perhaps we do not have. That's one of the secrets here, is you're always looking at various different angles here to see what is actually going to affect future future activities. Just looking at them, was hoping to get. Okay. Such as how immigration will help or hurt the economy here. One of the headlines: the consumer sentiment jumped in February, and excuse me. We'll look at this. We had Curtin here. We won't go over things that obviously we've already looked at, but this is a mid-month report here at 99.9 in February. The economists at the highest level since 2004. The economists at Reuters, their consensus was 95.5, so a little ahead of that. Numbers are marked at 4.4 increase. We went over that to start out with. The index measures 500 consumer attitudes on future economic prospects in areas such as personal finance, inflation, employment, government pricing, and interest rates. Of course, Dr. Curtin, we'd already talked about where Dr. Curtin was there. So we'll look at it in March as to will this sentiment remain, or is this an outlier? Well, we'll see. This will do it for us. For those in business, make next week a productive one. For the consumer, obviously, you are keeping your eyes on the prize. And we'll also be looking at the extra money, how it will filter back into the economy. Will consumers pay down their debts, or will they actually spend this money on retail items? That'll be a very big question there, and those are things we'll be looking at here, and we'll get back as the Fed gets more into macroeconomics, and we sometimes have to get a little bit into micro, but we won't get into utility functions here, we promise you. Good day. This is an addendum to the February 18th, 2018 This Week in Economics. We left out our housing segment, so we want to get this in. You'll get this at the end of the production This Week in Economics on the 18th of February 2018. We'll start with housing starts totaling 1.326 million in January versus 1.234 million starts expected here. And the U.S. housing market, this is from CNBC. New home construction increased to more than a one-year high in January, boosting the rebound in the building of single-family housing units, and further gains are likely as building permits soar to their highest level since 2007. Housing starts jumped to 9.7% to a seasonally adjusted annual rate of 1.329 million units. The Department of Commerce said on Friday that was the highest level since October of 2016. Upward revision there of sales pace of 1.209 million units. Economists at Reuters had, what did they predicted? 1.234 million units there. So mortgage rates, of course, rising in tandem with bond rates on worries about inflation. Single-family home building, which accounts for the largest share of the market, increased 3.7% to a rate of 877. In other words, 877,000 units in January. Single-family construction rose in the South and Northeast, but fell in the Midwest and West. Single-family home permits fell 1.7 in January. A survey on Thursday showed confidence among home builders hovering at a lofty level in February. Builders expect an increase in sales over the next 6 months. starts for the volatile multifamily housing segment surged 23.7% to a rate of 449,000 units in January. Permits for construction of multifamily homes soared 26.5%. Very interesting figure there at best. And January being in the winter months, usually your building is less there. And of course, housing sales are done in more or less in the spring months. So this was actually a Reuters article here, I suppose. Anyway, one other thing going on here. This is from CNBC. CNBC carried the Reuters article. And this is the one I was trying to find here. The major apartment developer, there's an acute crisis ahead our way. The luxury market is largely overbuilt. Well, there's a shortage, of course, of affordable housing across the country. Low and middle income households are spending proportionally more on their rent. Say apartment developer Tony Bazluto. Nearly half of all rent households pay more than 30%.
New data out suggests that America's apartment market is a mess, and one major developer says there is a crisis headed our way. Diana Olick joins us from a luxury building in Washington with that story. Hey, Diana.
Hey, and so if you want or can afford a swanky luxury apartment like this one, fantastic, because there are lots and lots of them and landlords are giving away concessions. But that is not the case in the rest of the rental market, where more affordable apartments are desperately needed and rents are still rising, driving inflation. Multifamily construction is now at a 40-year high. Completions last year jumped 46% from 2016, more than doubling the long-term average, that according to RealPage. The trouble is 80% of that is luxury. Why? Because of the high costs of land, labor, and materials. Construction costs up 1% per month for the last 36 months. Developer Toby Bizzuto faces ever more difficult financing on every new project. The Bizzuto Group has a portfolio of about 70,000 units, mostly luxury. His tenants spend a relatively low share of their high incomes on rent.
That being said, it is a tale of two cities. In the middle income and the lower income market, people are spending proportionally more on their rent. So much so that I believe there's an acute crisis headed our way.
Now, there are some low-income housing tax breaks for builders, but Bizzuto says there are too many developers competing for far too few credits. And it is really becoming a crisis. Lots more of this on CNBC.com.
That was Diana Olick. She's been around for a very long time. She used to be on the public TV channel. And if there's anything else we can grab out of this article here. Basically, he ran over that. But most of this so-called building is in the luxury apartment range here. The cost, and this is, well, we're getting to some of this. The luxury market here, developers simply can't afford to add anything but luxury.
We're vulnerable because we continue to underestimate the capabilities of those countries. I mean, WannaCry from North Korea, no one in the U.S. cybersecurity services believed the North Koreans could actually do that. NotPetya, just coming over from the Russians, the damage that did to the Ukrainian GDP, we're talking half a point.
Okay, we'll get rid of that. That was on something else. But anyway, back to our 2x4 cost here. We sort of left it here someplace. Anyway, we wanted to get 47% of all renting households, that's 21 million, pay more than 30%. I think we talked about that. That is from the Harvard Joint Center for Housing Studies. That was a report in 2017. We'll see if we can find a report and append it on here. And here we go. The cost of 2x4 lumber is now at a record high. Other products like steel, cement are more expensive, but the real cost spikes are in land and labor. Skilled construction labor is not only expensive, it's extremely difficult to find. And So those are some of the things out here. The government programs that offer developers financial incentives for low-income housing, but they don't meet the needs. And many developers are literally chasing at the same thing. So this is continually a problem, no doubt about it, and we'll continue to look at this. We put this in as an addendum because basically what we wanted to do here was not leave out very important item, housing costs from Reuters and CNBC. So this is to our program. We could not afford to leave it out. And very quickly here, we'll look at the Harvard study because we do have the time. We are pinching this 2-hour report, and hopefully we'll have it out here. I'm not certain as to where it is. Perhaps on the research here. Well, we'll see. Oh, here we go. The state of the nation's housing is the report itself, and this was the one evidently in, I think, in late 2017, and we'll have to get this out and see exactly where we are on this from them. Anyway, we'll put this on this particular program. We'll have to find it later. Nonetheless, this will do it for us. Once more, goodbye.